We're headed into a government shutdown at midnight, so let's take a look at what happens with markets. The most recent one we had was at the end of 2018 and lasted 34 full days, which also happens to be the longest we've had on record. In a typical shutdown, non-essential workers are furloughed, and essential employees work without pay. In 2019, they passed a law for these situations so that whenever the shutdown does get lifted, that the workers are back paid. The rule of thumb that most economists agree on is that there's about a 0.1% drag on GDP growth for each week of the shutdown, but that the GDP effect is largely reversed after the shutdown period ends. We had our beloved Tick Up Quant run a backtest on the December 2018 shutdown. We indexed the chart so that the start of the shutdown was at 0% and looked at how the S&P 500, gold, and treasuries performed. We had a decent sell-off in equities going into the shutdown, but this was a combination of factors. The Fed had its fourth hike of the cycle on December 19th, right ahead of the start of the shutdown on the 22nd, and in its guidance stated that more tightening was coming, and it spooked the market. It actually ended up being their last hike of the cycle. We also had the backdrop of the first trade war during this time, and it led to Powell pivoting in early January 2019. This time around, Powell believes stocks are expensive, though he does have room to cut, and previous shutdowns show that the economic impact is minimal. While shutdown risks to the market seem relatively low, yesterday, the AI-powered lender Upstart reported that they're facing increased delinquencies in their consumer personal loans. So some signs of slowing are starting to show, with the middle class that's starting to feel the inflation fatigue, which can start to affect corporate earnings. This is not financial advice, always view and research.